You know what's funny about investing? Most people think the secret to getting rich is finding the next hot stock tip or timing the market perfectly. That's garbage. Complete nonsense. The real magic happens when you understand something so simple that a 10-year-old could grasp it in 2 minutes, yet so powerful that it turned a $20 million fund into $14 billion during my time at Fidelity. I'm talking about compounding. And I'm not just talking about the boring textbook definition you learned in school. I'm talking about how compounding actually works in the real world, with real companies, real money, and real people like you and me. Here's the thing that drives me crazy. When most people hear about compounding, their eyes glaze over. They think it's some abstract mathematical concept that only matters to accountants and finance professors. But compounding is the most exciting, most interesting, most powerful force in investing. It's what separates the teachers and bus drivers and nurses who retire as millionaires from the folks who earn the same salaries but end up with nothing. And the best part? You don't need to be a genius to make it work. You just need to understand what it really means and have the patience to let it do its thing. Let me start with how I learned about the true power of compounding, not from a textbook, but from watching it happen right in front of my eyes. When I took over the Magellan Fund in 1977, we had about $20 million in assets. Nothing special. We owned maybe 40 companies, and the whole approach was conservative, careful, boring. But I had this crazy idea that if you found companies with great stories, companies that were growing their earnings year after year, and you just held on while they did their thing, something magical would happen. And you know what? I was right. Over 13 years, that 20 million became 14 billion. Not because I was smarter than everyone else or because I had some secret formula. It happened because I understood that when you own a piece of a business that's growing its earnings at 20% or 25% or 30% a year, and you reinvest those gains, and you let time work for you, the numbers start doing something that seems almost impossible. They start accelerating. The first few years feel slow. You're watching your investments grow, sure, but it doesn't feel revolutionary. Then something happens around year 5, year 7, year 10. The numbers start doubling faster. What took 5 years to double now takes 3 years. What took 3 years now takes 2. That's compounding in action. But let's back up because I'm getting ahead of myself. What actually is compounding? In the simplest terms, it's earning returns on your returns. You invest $1,000 at 10%, you make $100 the first year. Simple enough. But in year 2, you're not earning 10% on $1,000 anymore. You're earning it on $1,100, you make $110. Year 3, you're earning it on $1,210, you make $121. See what's happening? Each year, the base gets bigger, so the absolute dollar amount you're making gets bigger, even though the percentage stays the same. Now, I know what you're thinking. Big deal, Peter. An extra $10 here, $20 there, that's not life-changing money. And you're right. In the short term, it's not. But here's where it gets interesting. This is where people completely underestimate what's happening. Give it time. Real time. Not 2 years or 5 years. I'm talking 10 years, 20 years, 30 years. Because something wild happens when you stretch out the timeline. That $1,000 at 10%, after 10 years, it's not $2,000. It's $2,594. After 20 years, it's not $4,000. It's $6,727. After 30 years, it's $17,449. The same annual return, but the curve isn't a straight line going up gradually. It's a hockey stick that starts flat and then shoots vertical. Warren Buffett, who's a smart guy even if he's not as fun as I am, calls this the snowball effect. You start with a small snowball at the top of a hill, you push it down. At first, it's tiny, rolling slowly, picking up a little snow here and there, but as it rolls, it gets bigger. And as it gets bigger, it picks up more snow with each rotation. And the bigger it gets, the faster it grows. Before you know it, you've got this massive snowball barreling down the mountain, and it's adding more snow in one rotation than it did in the first 100 rotations combined. That's what happens with your investments when you give them time and let compounding work. But here's the part that almost nobody talks about. The part that makes all the difference between amateur investors who do okay and the ones who do spectacularly. Compounding doesn't just apply to your money sitting in an account earning interest. It applies to the businesses you own. And this is where it gets really fun. Because now we're not talking about 5% or 7% or even 10% returns. We're talking about companies that can compound their earnings at 15, 20, 25, even 30% a year. When you own pieces of businesses like that and you hold them for the long run, you're not just getting the mathematical compounding of your returns, you're getting the business itself compounding its value. Let me give you a real example from my days running Magellan, because this is how compounding actually works in the real world with real companies. Take Taco Bell. Now, I know what you're thinking. Taco Bell? You made money on cheap burritos and tacos? Yes, I did. A lot of money. And here's why. In the early 1980s, I'm walking around, doing my thing, and I notice these Taco Bell restaurants popping up everywhere. I go into one, the place is packed. I go to another city, packed again. So I start doing what I always do. I start asking questions. What's the food cost? What are the margins? How much does it cost to open a new location? What's the franchise model look like? Can they scale this? What I found was a business printing money. They were selling burritos and tacos for 59 cents, but the margins were fantastic. The menu was simple, which meant low food costs and easy operations. The franchise model meant they could expand without needing huge amounts of capital. Every time they opened a new store, boom, more earnings. And the stores they already had, same-store sales were growing because people loved the food and kept coming back. The stock was trading cheap. Nobody on Wall Street cared about it yet. It was a small company, kind of boring, selling Mexican fast food. But I saw something they didn't. I saw a compounding machine. Now here's the thing. I didn't buy Taco Bell and sell it 3 months later because it went up 15%. I held it for years because I understood that this business was going to compound its earnings. Every year, they opened more stores. Every year, the stores they already had did more business. Every year, the earnings grew. And because I held the stock, I got to participate in all that growth. The stock went from around $7 when I started buying to over $40 when PepsiCo acquired them. That's not a double or a triple. That's a 7-bagger, 7 times my money. And it happened because I let the business compound and I didn't get in the way. Here's another one. Dunkin' Donuts. I love this story because it shows how compounding works in businesses with recurring revenue. I'm at a Dunkin' Donuts one morning getting coffee, and I notice something. The same people are there every day. Same time, same order. These weren't occasional customers. These were habitual customers. Coffee and donuts in the morning was part of their routine. That's when the light bulb went off. This is a business with predictable, recurring cash flow. People aren't buying donuts once in a while. They're buying them every single day. So I dig into the numbers. Franchise model, just like Taco Bell. Low capital requirements, high returns on equity, simple operations, strong unit economics. The business was growing steadily, opening new locations, and the existing locations were spitting out cash like clockwork. The stock was undervalued. I bought it. I held it. I let the earnings compound year after year. Dunkin' eventually got acquired by private equity, and I walked away with a 5 to 7 times return. Another multi-bagger, and it came from something as simple as coffee and donuts. Now, you might be thinking, okay, Peter, that's great for you. You had millions of dollars to invest and a team of analysts at Fidelity helping you research these companies. What about me? I'm just a regular person with a regular job trying to save for retirement. Does compounding work for me the same way? And the answer is absolutely yes. In fact, you have advantages I didn't have. You can invest in smaller companies that I couldn't even look at by the time Magellan had billions under management. You don't have clients breathing down your neck demanding quarterly returns. You can take your time, find great businesses, and let them compound for decades without anyone telling you to sell. Let me give you an example. Say you're 25 years old and you start investing $1,000 a year into good businesses that average 10% returns. That's the historical average of the stock market, nothing fancy. You do this for 40 years until you're 65, you've put in $40,000 of your own money. But you know what you end up with? $486,000. Nearly $500,000 from putting away $1,000 a year. That's compounding. That's the magic of time and reinvested returns. But let's say you're a bit more ambitious. Instead of $1,000 a year, you save $100 a month. That's $1,200 a year, about the price of a couple of dinners out each month. Same 40 years, same 10% average return, you end up with $584,000. You're more than halfway to $1 million, and all you did was skip a few restaurant meals each month and let compounding do the heavy lifting. Now let's take it one step further. What if instead of just investing in the broad market at 10%, you actually do your homework like I'm always telling you to do? You find businesses you understand, businesses growing their earnings at 15 or 20% a year, you hold them for the long term. Suddenly, we're not talking about 10% returns anymore. We're talking about 15 or 20%. And here's where the numbers get really exciting. That same $100 a month at 15% for 40 years, $1.4 million. That 20%, $4.7 million. Same $100 a month, same time horizon. But because you've found better businesses and let them compound at higher rates, you went from $500,000 to nearly $5 million. That's not a small difference. That's life-changing wealth. And before you tell me that 20% returns are unrealistic, let me remind you that during my 13 years at Magellan, the fund averaged 29% annual returns. Not 10, not 15, 29. Now, I'm not saying you're going to match that, and I'm certainly not guaranteeing anything. But the point is this: when you find great businesses, businesses with real earnings growth and strong fundamentals, and you hold them for the long run, you can absolutely beat the market averages. And when you compound at higher rates for long periods, the difference is astronomical. But here's the thing everyone misses about compounding. It's not just about the math. It's about behavior. Because the math only works if you actually let it work. And that means you have to hold on when things get scary. You have to hold on when the market drops 20% and everyone's panicking. You have to hold on when your stock goes down, even though the business fundamentals haven't changed. You have to hold on when your friends are making fast money on some hot new stock and you feel like you're missing out. This is where most people fail, not because they don't understand compounding, but because they can't sit still long enough to let it happen. I remember during the October 1987 crash, the market dropped 22% in a single day. One day. That's terrifying. People were selling everything. Panic everywhere. But you know what I did? I looked at the businesses I owned. Were they still making money? Yes. Were they still growing? Yes. Had anything fundamental changed about their ability to earn profits? No. So I held on. In fact, I bought more because I understood that short-term volatility is the price you pay for long-term returns. You want the benefits of compounding? You have to endure the volatility. There's no way around it. And this is why I always tell people that your edge as an amateur investor isn't that you're smarter than the professionals, it's that you can afford to think longer term. The professionals have clients who freak out every time the market drops. They have quarterly performance reviews. They have bosses telling them to reduce risk. You don't have any of that. You can buy a great business and hold it for 10 years, 20 years, 30 years. That's your advantage. That's how you let compounding work its magic. The professionals are worried about what happens next quarter. You should be thinking about what happens next decade. Let's talk about what actually drives compounding in a business, because this is where it gets practical. When I look at a company, I'm asking myself one question above everything else. Can this business grow its earnings for a long time? Not next quarter, not next year, for years and years into the future. Because if it can, and if I buy it at a reasonable price, compounding will take care of the rest. So what makes a business capable of compounding its earnings over long periods? First, it needs a product or service that people want and will keep wanting. This sounds obvious, but it's amazing how many people invest in businesses without thinking about whether anyone will care about their product in 5 or 10 years. When I invested in Dunkin' Donuts, I wasn't worried about demand going away. People have been drinking coffee for hundreds of years. They're going to keep drinking coffee. That's a product with staying power. Same with Taco Bell. People like eating cheap, tasty food. That demand isn't disappearing anytime soon. You want businesses where the demand is durable, not some fad that might be gone in 3 years. Second, the business needs room to grow. This is critical. A company can have the best product in the world, but if they're already everywhere and have saturated their market, there's nowhere for earnings to go. When I found Taco Bell, they had maybe a few hundred locations. The potential to open thousands more was obvious. Every new location meant more earnings. That's growth potential. Same thing with Dunkin'. They were concentrated in the Northeast. The rest of the country barely had any locations. That's room to grow. You want to find businesses in the early innings of their growth story, not the 9th inning. Third, and this is huge, the business needs to generate cash and be able to reinvest that cash at high rates of return. This is the engine of compounding. If a business makes $1 million in profit but has to spend $900,000 on maintaining its operations, There's only 100,000 left to reinvest. That's not going to compound much. But if a business makes $1 million in profit and only needs 200,000 to maintain operations, now you've got 800,000 to reinvest in growth. That's a compounding machine. This is why I love franchise businesses like Dunkin' and Taco Bell. Low capital requirements, high returns on invested capital. They could grow without needing massive amounts of money. The cash they generated could be reinvested to open more locations, which generated more cash, which opened more locations. That's compounding at the business level. Fourth, the business needs good management. I've seen plenty of companies with great products and huge markets ruined by terrible management. You need people running the company who understand capital allocation, who know how to reinvest profits wisely, who aren't wasting money on stupid acquisitions or paying themselves ridiculous salaries. Good management makes smart decisions that compound the business value over time. Bad management destroys value. It's that simple. When I meet with management teams, I'm looking for people who think like owners, not like hired guns trying to pump the stock price for the next bonus. Fifth, the business should have some kind of competitive advantage, what Buffett calls a moat, something that protects it from competitors coming in and stealing market share. Maybe it's a strong brand. Maybe it's low-cost production. Maybe it's a network effect where the product gets more valuable as more people use it. Whatever it is, you want something that gives the business staying power that allows it to keep earning profits year after year without getting undercut by the competition. Without a moat, competitors will eventually erode the margins and kill the compounding. Now, here's what's interesting. When you find a business that has all these characteristics, you don't need it to be a rocket ship growing at 50% a year. In fact, those businesses are usually risky because that kind of growth is hard to sustain. What you want is a business that can grow earnings at 15, 20, maybe 25% a year for a long time. That's the sweet spot. Because when you compound at those rates for 10 or 15 or 20 years, you get multi-baggers. You get 5-baggers, 10-baggers, even 100-baggers if you're lucky and patient. Let me give you the math on this because the numbers are stunning. Say you find a business earning $1 per share and it grows earnings at 20% per year. After 5 years, it's earning $2.49 per share. After 10 years, $6.19. After 15 years, $15.47. After 20 years, $38. That's 38 times more earnings than when you started. Now, stocks don't always trade perfectly in line with earnings, but over long periods they track pretty closely. So if the stock was trading at $10 when it earned $1 per share, giving it a price-to-earnings ratio of 10, and it still trades at a PE of 10 when it's earning $38 per share, that stock is now worth $380. You turn $10 into $380, that's a 38-bagger from one company over 20 years by simply holding while the earnings compounded. And here's the kicker. In real life, when a company consistently grows earnings at 20% for 20 years, the market usually gets excited and gives it a higher valuation. So instead of a PE of 10, maybe it trades at a PE of 15 or 20 by the end. Now your $38 in earnings is worth $570 or $760. Your $10 investment is now worth 57 times or 76 times what you put in. That's how you get 100 baggers. Not from trying to trade in and out, not from timing the market, but from finding great businesses and letting compounding do its thing while the market eventually recognizes the quality of what you own. But compounding doesn't just work with individual stocks. It works with your entire portfolio if you're smart about it. This is where reinvesting dividends and capital gains comes in. Let's say you own a stock that pays a 3% dividend. You can either take that dividend as cash and spend it, or you can reinvest it by buying more shares. If you reinvest, now you own more shares, which generate more dividends next year, which you reinvest to buy even more shares, which generate even more dividends. You're compounding your ownership in the business. Same thing with capital gains. Let's say one of your stocks doubles and you sell it. You can take that money and spend it, or you can reinvest it into another great business. If you reinvest, that money keeps compounding. Over a lifetime of investing, the difference between taking your gains out and reinvesting them is massive. Because every dollar you pull out is a dollar that stops compounding. Every dollar you reinvest keeps working for you, keeps growing, keeps building wealth. This is why the richest investors, people like Buffett, almost never sell. They let their winners keep compounding for decades. because they understand that time in the market is more valuable than anything else. Let me tell you about another aspect of compounding that people don't appreciate enough, the psychological aspect. Because watching compounding in real time is boring. I'm serious. It's not exciting. In the first few years, your money grows slowly. You're putting away money every month. Your investments are going up a little bit, but it doesn't feel like you're getting rich. This is when most people give up. They think, this isn't working, I need to do something more aggressive. They start chasing hot stocks or trying to time the market, and they destroy their compounding. But if you can push through that boring phase, if you can keep doing the simple things like saving regularly and holding good businesses, something magical happens around year 5 or 6 or 7. You start noticing that your account balance is growing faster than it used to, not because you're putting in more money or because your returns got better, but because the base is bigger now. The snowball is rolling. And then around year 10, it really takes off. The absolute dollar amounts you're making each year start to dwarf what you were making in the early years. That's when compounding stops feeling boring and starts feeling powerful. I've seen this pattern over and over with regular investors who did it right. They start in their 20s or 30s, putting away a few $100s a month. For the first decade, it feels slow. They've got maybe $50,000 or $100,000 saved up. That's real money, sure, but it's not life-changing. But they keep going. They don't panic when the market drops. They don't chase fads. They just keep saving and holding good businesses. Then they hit year 15, year 20, and suddenly they've got $300,000, $500,000, $1 million. They didn't change anything. They just let compounding do its thing for long enough that the exponential curve kicked in. This is why starting early is so important, not because you need to invest a lot of money when you're young, but because you need to give compounding time to work. If you start at age 25 and invest until age 65, you have 40 years of compounding. If you start at age 45, you only have 20 years. The difference is enormous. Remember that example I gave earlier about investing $100 a month at 10%? Over 40 years, you end up with $584,000. But over 20 years, you only end up with $76,000. Same monthly investment, same return, but half the time. And you don't get half the money. You get 1/7 of the money. That's the power of time and compounding. Every year you wait is a year you can't get back, and it costs you exponentially. Now let's talk about the enemies of compounding, because there are plenty of them, and if you don't watch out, they'll kill your returns. The first enemy is fees. Every dollar you pay in fees is a dollar that stops compounding. If you're paying 2% a year in fees to some financial advisor or mutual fund manager who's not even beating the market, that's 2% of your money that's not compounding. Over 30 years, that 2% can reduce your final portfolio by more than 40%. It's staggering. This is why I'm such a big fan of low-cost index funds for people who don't want to pick individual stocks. Pay as little as possible in fees and let compounding work on the maximum amount of your money. The second enemy is taxes, but this one you can manage if you're smart. If you're constantly buying and selling, you're generating short-term capital gains taxed at your ordinary income rate. That's money going to the government instead of compounding in your account. But if you hold your investments for more than a year, you get long-term capital gains treatment, which is a lower tax rate. Better yet, if you hold your investments in a retirement account like a 401k or an IRA, the money compounds tax-free or tax-deferred until you retire. That's huge. You're keeping Uncle Sam's hands off your compounding for decades. Use those tax-advantaged accounts. Max them out if you can, because every dollar that would have gone to taxes is instead compounding and growing your wealth. The third enemy is inflation. This one's sneaky because it doesn't feel like you're losing money, but you are. If inflation is running at 3% a year and your investments are only growing at 3%, you're not actually getting ahead. You're treading water. Your dollars buy less and less each year. This is why you need to invest in assets that grow faster than inflation. Stocks, real estate, businesses, things that produce earnings and cash flow that rise over time. If you leave your money in a savings account earning 1% while inflation is 3%, you're losing 2% of purchasing power every year. That's the opposite of compounding. That's compounding losses. The fourth enemy, and maybe the biggest one, is yourself. Your emotions, your impatience, your fear, your greed. These are the things that make you sell when you should hold, buy when you should be patient, chase fads when you should stick to quality. I can't tell you how many people I've met who understood compounding perfectly on paper but couldn't execute it because they couldn't control their emotions. The market drops 10% and they panic and sell everything. They miss the recovery. Or they see some stock triple in a month and they pile in at the top, then it crashes and they lose half their money. They're not letting compounding work because they're constantly interrupting the process. This is why I always say investing is more about temperament than intelligence. You don't need to be a genius to let compounding work. You need to be patient. You need to be disciplined. You need to be able to sit on your hands when everyone around you is panicking or getting greedy. You need to stick to your plan. Buy quality businesses at reasonable prices. Hold them while the earnings compound. Ignore the noise. Don't check your portfolio every day. Don't panic when it drops. Don't get overconfident when it surges. Just let it compound. It's simple, but it's not easy, because it requires controlling the most unpredictable variable in investing, which is you. Let me give you a real-world example of how patience and compounding pay off. Take someone like a teacher who starts investing at age 30. She makes a modest salary, maybe $50,000 a year. She can't invest thousands of dollars a month, but she commits to putting away $300 a month into a diversified portfolio of good businesses or a low-cost index fund. She gets a 10% average annual return, which is reasonable over the long term. She does this for 35 years until she retires at 65. Over that time, she's contributed $126,000 of her own money, but when she retires, her account is worth $1.1 million. She's a millionaire. From $300 a month and the power of compounding. Now, let's say her colleague, another teacher making the same salary, waits until age 40 to start investing. Same $300 a month, same 10% return, but only 25 years instead of 35. This person contributes $90,000 over those 25 years. Seems like it shouldn't be that different, right? She put in a bit less money and had a bit less time, but her final account value is only $354,000. That's less than a third of what the first teacher ended up with. The first teacher invested $36,000 more and got $650,000 more in return. That's an 18-to-1 ratio. Every dollar invested in those first 10 years had 18 times more impact than the dollars invested later. That's the power of starting early and giving compounding time to work. Now, let's talk about how to actually find businesses that will compound over long periods, because this is where the rubber meets the road. I've given you the theory and the math, but how do you actually do this in practice? It starts with looking at the world around you and paying attention. This is what I mean when I say invest in what you know. You have information about great businesses right in front of you every single day, and you're probably ignoring it. Think about the companies whose products and services you use. Think about the stores you shop at, the restaurants you eat at, the apps on your phone, the brands in your closet. Are any of them exceptional? Are any of them growing? Are any of them taking market share from competitors? When I found Dunkin' Donuts and Taco Bell, I wasn't reading research reports from Wall Street analysts. I was walking around with my eyes open. I was eating the food, talking to customers, noticing the crowds. That's the beginning of every great investment idea, real-world observation. Once something catches your attention, the next step is to dig into the numbers. You don't need to be an accountant, but you need to understand the basics. Is the company making money? How much? Is revenue growing or earnings growing faster than revenue, which means margins are expanding? That's a good sign. What about debt? If the company has tons of debt, that's a red flag. Debt limits flexibility and creates risk. What about return on equity? This tells you how efficiently the company is using shareholder money to generate profits. You want high returns on equity because that means the company is compounding its capital effectively. Then you need to understand the story. Every company has a story. Why does this business exist? What problem does it solve? Why do customers choose this company over competitors? How does the company make money? Can they keep making money this way for the next 10 years? If you can't explain the story in 2 minutes to a 10-year-old, you probably don't understand it well enough to invest. The best businesses have simple, clear stories. Dunkin' sells coffee and donuts to people who want a quick, affordable breakfast. Simple. Taco Bell sells cheap Mexican food that tastes good and has high margins. Simple. If the story is convoluted or confusing, move on. You also need to think about valuation. Even the best business in the world is a bad investment if you pay too much for it. I always look at the price-to-earnings ratio compared to the growth rate. I call this the PEG ratio. If a company is growing earnings at 20% per year and it's trading at a PE of 10, that's a peg of 0.5. That's cheap. If it's growing at 20% and trading at a PE of 40, that's a peg of 2. That's expensive. You want to find companies where the peg is under 1, ideally under 0.7 or 0.8. That means you're getting growth at a reasonable price. When you buy quality businesses at reasonable valuations and hold them while they compound, that's when you make serious money. And here's something people forget. You don't need to find the next Amazon or Apple. Those are once-in-a-generation companies. You can do incredibly well finding boring, steady businesses that grow earnings at 15 or 20% for a decade or two. Home Depot in the 1980s and 1990s wasn't some flashy tech company. It was a hardware store. But it was a hardware store that was expanding rapidly, had great management, and was compounding earnings at high rates. If you bought it early and held it, you made a fortune. Same with Walmart. Same with Subaru. Boring businesses, incredible compounding. The key is to find businesses in the early or middle stages of their growth curve. If they've already grown massive and have saturated their market, the compounding slows down. That's why I loved small and mid-cap companies. They had more room to grow. A company with $100 million in revenue can double to $200 million, much easier than a company with $100 billion in revenue can double to $200 billion. The smaller companies have more runway, and that means more potential for compounding. This is one of the advantages you have as an individual investor. I couldn't invest in tiny companies once Magellan got huge. But you can. You can find small, overlooked businesses that Wall Street isn't paying attention to and hold them while they grow into giants. Let me give you a framework for categorizing companies, because not all businesses compound the same way. I think of companies in 6 categories. Slow growers are big, mature companies that grow earnings at maybe 5% a year. Utilities, big consumer staples companies, they're safe and stable but won't make you rich through compounding. Stalwarts are big, solid companies growing at 10 to 12%. Think Coca-Cola or Procter & Gamble. They'll do fine over time but won't give you explosive returns. Fast growers are where the magic happens. These are companies growing earnings at 20, 30, even 40% a year. They're usually smaller companies in high-growth industries. This is where you find 10-baggers and 100-baggers. But they're also riskier because high growth can't last forever. Cyclicals are companies whose earnings rise and fall with the economic cycle. Auto companies, steel companies, airlines. You can make money in cyclicals if you buy them when they're down and sell when they're up, but they don't compound steadily, so they're tricky. Turnarounds are companies that have been struggling but have potential to recover. These can be lucrative if you're right, but they're risky because many turnarounds don't turn around. Asset plays are companies sitting on valuable assets that the market hasn't recognized. Real estate, natural resources, that kind of thing. If you can find a company trading for less than the value of its assets, that's interesting. For compounding, you want to focus most of your portfolio on fast growers and stalwarts. Fast growers give you the high return compounding, stalwarts give you stability and steady compounding. A mix of both is a smart approach. Avoid having too much in cyclicals or turnarounds because those don't compound predictably. And slow growers, well, they're fine if you want safety, but don't expect them to make you rich. Another important aspect of compounding is reinvestment. You want to own businesses that reinvest their cash flows at high rates of return. Let's say a business earns $100 million in profit. If they pay all of it out as dividends, it's not compounding inside the business. It's compounding in your account if you reinvest the dividends, which is good, but not as powerful. But if they take $50 million of that profit and reinvest it into opening new stores or developing new products or expanding into new markets, and they're getting a 20% return on that investment, now they're earning an extra $10 million in profit next year. That $10 million gets reinvested, earning another $2 million, and so on. The business itself is compounding its earnings internally. That's what you want. This is why companies with high returns on invested capital are so valuable. They can reinvest their profits at high rates, which compounds the earnings, which increases the stock price, which makes you rich. Companies with low returns on invested capital can't do this. They generate cash but can't reinvest it effectively, so they either pay it out as dividends or waste it on bad acquisitions. You want to avoid those businesses and focus on the ones that are efficient compounding machines. I also want to talk about the importance of diversification in the context of compounding. You shouldn't put all your money in one stock, no matter how confident you are. I owned hundreds of stocks in the Magellan Fund because I knew that not every investment would work out. Some businesses fail. Some industries get disrupted. Some managements make bad decisions. If you only own one or two stocks and one of them blows up, you've destroyed years of compounding. But if you own 15 or 20 carefully chosen stocks and one fails, it's only a small part of your portfolio. The others keep compounding and you're fine. That said, you also don't want to own 100 stocks like I did unless you have the time and resources to track them all. For most individual investors, 10 to 20 stocks is plenty. Enough diversification to protect you from disasters, but not so many that you're diluting your returns by owning mediocre businesses. Focus on quality. Own pieces of businesses you understand, businesses with strong fundamentals, businesses that can compound earnings for years. Hold them for the long term. Let compounding do the work. The final thing I'll say about compounding is this: it rewards patience more than anything else. The math works the same for everyone. You don't need to be smarter than other investors. You don't need access to insider information. You don't need a finance degree. You just need to understand the businesses you own, buy them at reasonable prices, and hold them while the earnings compound. The hardest part is sitting still, doing nothing, ignoring the market noise, resisting the urge to tinker with your portfolio every time something happens in the news. The investors who get rich from compounding are the ones who can do nothing for years and years. They buy, they hold, they let time work. I've watched this happen over and over. The amateur investors who beat the professionals aren't the ones trading constantly or chasing hot tips. They're the ones who find a few great businesses and hold them for 10, 20, 30 years. They let compounding turn small amounts of money into life-changing wealth. They understand that the real secret isn't finding the perfect stock or timing the market perfectly. The real secret is time itself. Give compounding enough time, and it will do things that seem impossible. It will turn thousands into millions. It will turn ordinary savers into wealthy retirees. It will give you financial freedom without you having to be a genius or take massive risks. That's how compounding really works. Not in theory, but in practice. Not in textbooks, but in the real world with real businesses and real money. It's the most powerful force in investing, and it's available to anyone willing to be patient and disciplined. So find businesses you understand. Buy them at fair prices. Hold them for the long term. Reinvest your gains. Ignore the noise. And let compounding do what it does best, which is turn time into wealth. It's not complicated, it's not sexy, but it works. And if you can stick with it long enough, it will change your life. Now I want to talk about something that most people never think about when it comes to compounding, and that's the compounding of knowledge. See, the longer you invest, the better you get at it. Every mistake teaches you something. Every success reinforces good habits. Every annual report you read, every business you study, every management team you meet, you're building up this library of knowledge and pattern recognition. That knowledge compounds just like your money does. After 20 years of investing, you see things that newer investors miss. You recognize red flags faster. You spot opportunities quicker. You make better decisions. That's compounding too, and it's incredibly valuable. I remember when I first started at Fidelity, I made plenty of mistakes. I bought companies I didn't understand well enough. I sold winners too early because I got nervous. I held losers too long because I was stubborn. But each mistake taught me something, and over time I got better. By the time I was running Magellan, I had this massive database in my head of what worked and what didn't. I could walk through a store and immediately assess whether it was a good business. I could read an annual report and spot the important details in minutes. That didn't happen overnight. It compounded over years of experience. This is why I always tell young investors not to get discouraged if they make mistakes early on. You will make mistakes. Everyone does. The key is to learn from them and keep going. Each year you invest, you're not just building wealth, you're building expertise. And that expertise makes you a better investor, which helps you find better opportunities, which compounds your wealth faster. It's a virtuous cycle, but only if you stick with it long enough for the cycle to work. Let me give you some specific examples of how I used compounding to build massive positions in the Magellan Fund. Take Chrysler in the early 1980s. The company was basically bankrupt. Everyone on Wall Street thought it was going under. The stock was trading at $2, but I looked at the fundamentals and saw something different. They had a new management team under Lee Iacocca. They were launching new products like the K-Cars and the minivan. The government had backed their loans, so they had breathing room. The business was fixable. So I bought a huge position when everyone else was selling, The stock went from $2 to $10 in under 2 years. That's a 5-bagger. Then it kept going. Within 5 years, it was $30. That's a 15-bagger from the bottom. Now, the easy thing would have been to sell when it doubled or tripled, take my profits, move on. But I understood that the earnings were compounding. Every year, Chrysler was selling more cars, making more profit, paying down more debt. The business was getting stronger, so I held on and let the compounding work. That patience turned a good investment into a spectacular one. The difference between selling at $10 and selling at $30 was enormous, and it came down to understanding that compounding takes time. Here's another one. Hanes, the company that made Legs pantyhose. My wife noticed these products in stores everywhere. Women loved them, they were cheaper than competitors, and the quality was good. I looked into the company and found exactly what I was hoping for. Low capital requirements, high margins, huge market potential. The stock was around $2 when I started buying. Within a few years, it was $12. A 6-bagger. Again, the key was recognizing a business that could compound its earnings for years and having the patience to hold it while that happened. Fannie Mae is another great example. This was in the 1980s when the mortgage industry was transforming. Fannie Mae was being rebuilt as a securitization machine. They were making a fortune on fees while reducing their interest rate risk. Wall Street didn't fully understand the business, so the stock was undervalued. I bought a massive position, around $200 million, for Magellan alone. Over the next several years, the stock went up 6 times. Across all of Fidelity's funds, we made over $1 billion on Fannie Mae. That's what happens when you find a business with strong fundamentals that can compound earnings at high rates, and you have the conviction to build a big position and hold it. These examples all have something in common. They weren't about getting lucky or having insider information. They were about understanding the businesses, recognizing the potential for earnings to compound, buying at reasonable valuations, and having the patience to hold while the compounding happened. That's the formula. It's simple, but it requires discipline and a long-term mindset. Now let's talk about what kills compounding, because understanding the mistakes is just as important as understanding the strategy. The biggest mistake I see people make is selling winners too early. They buy a stock at $10, it goes to $15, they sell and take their 50% profit, feeling smart. Meanwhile, the business keeps compounding and the stock goes to 30, 50, 100. They made 50% when they could have made 300 or 500 or 1,000%. This drives me crazy because it's such a common mistake. People are so afraid of giving back gains that they cut their winners short and destroy their compounding. I call this pulling out the flowers and watering the weeds. You sell the stocks that are going up and hold the ones that are going down, hoping they'll recover. It's exactly backward. You should be holding your winners as long as the fundamentals remain strong and selling your losers once you realize you made a mistake. Let your winners compound. Cut your losses before they compound negatively. This is basic, but so many people get it wrong because emotions get in the way. Another mistake is trying to time the market. People think they can sell before crashes and buy before recoveries. It doesn't work. Nobody can consistently predict short-term market moves. What happens is you sell, the market keeps going up, you wait for a crash that doesn't come, you miss out on months or years of compounding, or you sell during a crash, the market recovers, you're too scared to get back in, and you miss the recovery. Either way, you've interrupted the compounding process. The better approach is to stay invested through the ups and downs. Yes, you'll experience volatility. Yes, it's uncomfortable. But over long periods, the compounding more than makes up for the temporary drops. The third mistake is chasing hot stocks and fads. Every few years, there's some new trend that everyone's excited about. Internet stocks in the late 1990s, cannabis stocks, crypto, SPACs, whatever. People pile into these things at ridiculous valuations because they're afraid of missing out. Then the bubble pops and they lose half their money or more. They've not only failed to benefit from compounding, they've set themselves back years. Stick to real businesses with real earnings. Avoid speculation. It's the only way to let compounding work consistently over decades. The fourth mistake, and this one's subtle, is over-diversifying. If you own 50 or 100 stocks, you're basically owning the market. You'll get market returns, which is fine, but you won't beat the market. And you probably don't understand all those businesses well enough to know which ones can compound at high rates and which ones are mediocre. You're diluting your returns. Focus on your best ideas. Own 10 to 20 stocks that you really understand and really believe in. That concentration combined with compounding is how you generate exceptional returns. Don't be reckless and put everything in one stock, but don't be so diversified that you eliminate your edge either. So let me bring this all together with a final thought. Compounding is the closest thing to magic in investing. It takes ordinary amounts of money and turns them into extraordinary amounts of wealth. It takes small businesses and turns them into giants. It takes patient, disciplined investors and makes them rich. But it only works if you let it work. And that means you need to do a few simple things consistently over long periods of time. Find businesses you understand. Look for companies growing earnings at high rates with plenty of runway ahead of them. Make sure they have strong fundamentals, low debt, good management, and competitive advantages. Buy them at reasonable valuations. Then hold them while the earnings compound. Reinvest your dividends and capital gains. Stay invested through market volatility. Ignore the noise. Don't try to time the market. Don't chase fads. Don't sell your winners too early. Just let time do its thing. Give it 10 years, 20 years, 30 years. The longer you give it, the more powerful it becomes. This is how I turned 20 million into 14 billion at Magellan. Not by being brilliant or lucky, but by understanding compounding and having the patience to let it work. And this is how regular people, teachers and nurses and mechanics and office workers, build million-dollar portfolios from modest savings. They start early, they invest consistently, they own good businesses, and they let decades of compounding turn small amounts into fortunes. The beauty of compounding is that it doesn't discriminate. It works for everyone who has the discipline to use it. You don't need to be rich to start. You don't need to be smart. You don't need special access or insider knowledge. You just need to understand the basics, control your emotions, and give it time. If you can do that, compounding will change your financial life. It will give you security, freedom, options. It will let you retire comfortably, help your kids do the things you want to do. That's the real power of compounding. Not just making you richer, but giving you a better life. And it's available to anyone willing to be patient and disciplined enough to let it work.